Well, good morning, everybody. Thank you for tuning in and welcome to a set of presentations we're giving today on the spring budget, which is now just a couple of weeks away. It may come as a surprise to some of you listening that this will actually be the first budget since the autumn of 2021. All of those exciting fiscal events last year were not officially budgets. So it's something new for us to look forward to after an absence of more than a year, an actual, real, proper budget. So we are going to go through a few things this morning. 4 of my colleagues will speak, but don't worry, they're going to speak each for less than 10 minutes. We're going to kick off with Isabel, who will talk about the public finances. Then Ben will talk about public spending challenges. Heidi will talk about inflation and energy prices. And then Sam will round up by talking more about some of the cost of living issues and in particular, what's happening in the benefit system. They should be wrapped up within half an hour or so, maybe 40 minutes. We will then have plenty of time because we have an hour and a quarter in total to take your questions. You should all have a link to Slido where you can put your questions and vote other people's questions up. I will not interrupt my 4 colleagues as they move smoothly from one to the next, but I will pop up again after they finish speaking and then chair the Q&A. So do put your questions into Slido, vote up ones that you think are most relevant and important, and as I say, plenty of time to have that discussion and Q&A at the end. I will now turn off my camera and mute myself and watch my colleagues and listen to my colleagues tell us all about the background to the pretty serious challenges facing the Chancellor in a couple of weeks.
Thanks very much, Paul. So I'm going to kick us off by telling you a little bit about the outlook for the public finances, where we've really seen sort of different developments when it comes to the short term compared to the medium term. We've had some really good news for this year and perhaps the coming year, and a much more murky outlook when it comes to 3, 4, or 5 years from now. So let's start with that short-term good news, because who couldn't use a little bit of that? Casting our minds back to last November, when we had the last set of official forecasts, the OBR was forecasting a pretty severe recession this year, and the Bank of England in the same month agreed with their forecast. Now, that picture has changed a lot, and it's changed for the better. So the Bank of England's most recent forecast from this month, as well as other external forecasts, like that very well publicized one from the IMF in January, now still forecast a contraction, but a much smaller one. And they're not the only ones. So if we look at the whole suite of forecasts in the Treasury survey of independent forecasters, all the forecasts made in February, those on average now expect a contraction that's about half the one that the OBR forecast back in November. So really a contraction is still not a great thing, but still relatively a much more optimistic picture than back in November. And similarly, borrowing numbers in year have been coming in much below forecast, which we would also consider to be good news. So this line shows you the profile of borrowing that would be consistent with the OBR's November forecast. And this other one shows you a slightly adjusted, so as to be comparable, outturn for borrowing that we've had coming in from recent data. And the most recent vintage of data for January shows a gap of 31 billion between that forecast and that outturn. And just so as to leave nobody in any doubt, 31 billion is really a lot. If we look at all the distribution of all the gaps we've seen each year since the inception of the OBR, that gap between forecast and outturn, then this is around 3 times the average in-year gap. So this is really a lot. This is big news. So why has borrowing been coming in so much below forecast? Well, this line here shows you that the gap between the 2 lines from the previous chart, how much borrowing is running below the OBR November forecast. Now, one factor that there's been quite a lot of talk about is that subsidies have been cheaper than previously expected. And of course, the most high-profile ones, and that make up the bulk of spending this year in that subsidy category, are spending on energy support. But that's not the only driver. We've also been spending less on debt interest than previously expected. And what's perhaps the most interesting part of the story, tax revenues across a really wide range of taxes have been coming in stronger than would be consistent with the OBR's forecast. And that's true across a whole range of different taxes, but it's particularly true for income tax and national insurance contributions, and that's what I've plotted here. Now, what do we think that might mean for changes in the borrowing outlook next year? So the year starting in April. So again, thinking back to November, the OBR was expecting a deficit of 140 billion, which was hugely elevated on the previous forecast from just under a year ago in March. Now, we might think that there'll be a small saving on debt interest spending compared to that, and then a fair saving on energy support schemes. You'll hear more about those in some of the following presentations. Some of that saving, reflecting lower energy prices, will be counterbalanced by lower revenues from the energy profits levy, but still net it's a gain for the Exchequer. And now that big part of the story that I was telling you about is that we're now expecting a shallower recession and stronger revenues for a given size of the economy. All that is good news for borrowing, and we might expect it to take around 20 billion off of borrowing next year. So all in all, these factors might lead the OBR before any policy measures to revise borrowing down by around 31 billion. However, we might think that it's really all but inevitable that around 6 billion of that will be spent on yet another freeze to fuel duties. In the absence of any policy action, fuel duties would rise by 23%, 5p plus RPI. We might think that that's really politically an implausible thing to do. So that would leave us with an adjusted forecast for next year of around 115 billion, much improved on the November forecast, but still much elevated compared to a year ago. Now, the really interesting part is to think about how persistent these changes are likely to be. Because the case for a permanent tax cut or a permanent increase on spending doesn't rest on changes in the immediate outlook for this year or next year. If you want to make a case for that kind of change, you would have to argue that the longer term outlook is similarly improved. And apart from those sort of big picture issues, the Chancellor's particular fiscal rule is to have debt falling between the fourth and fifth year of the forecast. So that is also more of a medium term question. So thinking back to the sources of that improved borrowing this year and next, there's no energy price guarantee beyond next year. So sort of by definition, there also can't be any ongoing savings. We might think that there would be some persistent savings relative to the November forecast from lower interest rates. On current market expectations, that might reduce debt interest spending by around 4 billion in the last year of the forecast. But it's worth stressing that these market expectations do move around a lot, and rate expectations have been rising again very recently throughout this month. So this is an uncertain source of savings. And in the longer term, really the single most important factor for the health of the public finances is going to be economic growth. And on that front, we've sort of had a mixed bag of news. So I've already mentioned that in the short term, the Bank of England now forecasts a much, much shallower recession. So that's good news. But in the medium term, their forecast for the kind of trend growth, the growth that the UK economy could sustain in the longer term without generating excess inflationary pressure, is now really, really poor. So they now expect that that trend rate of growth is below 1%, which compared to almost any comparator you care to pick is very poor. In particular, it would be only around a third of the average growth rate in the long term, sort of the 50 years before the financial crisis, what we used to think was normal. Now, there are two factors that might help cushion the effect of any downgrade to growth, to real growth, that the OBR might choose to make. So if they do move closer to the Bank of England's medium-term growth forecast. One is inflation. So the public finances are very responsive to the cash size of the economy, not just to the growth in real output. And on that front, the OBR was expecting back in November for inflation to fall sharply and then to go through a period of really extremely low inflation and, in fact, deflation. And the bank now agrees that inflation is set to fall sharply, but they don't expect that period of deflation, of really extremely low inflation. They expect a period of still very low, below the 2% target, but not quite as low inflation. So if that extra inflation helps prop up the cash size of the economy, that would be good for revenues. And similarly, if the current strength in revenues we're seeing, that's sort of for any given size of the economy, if that persists into the medium term, that would also help cushion the public finances, even if a low rate of growth in output would still be bad news for the economy overall. Now, it's worth remembering, as we think about all these different moving parts that are all very uncertain, that back in November, debt was falling at the end of the forecast, meeting the Chancellor's fiscal target, but with really next to no headroom at all. It was falling by a margin of 9 billion, which in the sort of the scale of the uncertainties that we're talking about here is really just a hair's breadth. So it wouldn't take much to put debt on a rising path here. So that brings me to my conclusions. We're now expecting a sizable reduction in borrowing in the short term. The deficit for the current financial year is running more than 30 billion below forecast. That's a big gap in historical terms. And for next year, around a 25 billion improvement is very plausible after accounting for the all but inevitable freeze in fuel duties. Those temporary improvements are certainly very welcome, but they do not justify a permanent loosening, so a permanent tax cut or a permanent increase in spending. That case rests on the judgments that the OBR must take on growth and on the persistence of stronger revenues than we've previously been used to. And those are going to be key for the medium-term outlook. The Bank of England is forecasting a shallower recession, but really, really dismal trend growth going into the medium term. The OBR may move towards the bank, or they may well continue to be a little bit more optimistic. Now, there are really good reasons to want to have debt on a decisively falling trajectory in the medium term as a share of national income, not least because we want to have scope to increase debt sharply when the next crisis rolls around. But if we now see a small and uncertain revision to the outlook 4 or 5 years out that just about nudges debt to be, say, on a slightly rising path instead of that slightly falling path that we're seeing at the moment, that's not a great basis for immediate policy action. So to summarize, we might say that the case for any kind of permanent tax cut or permanent spending increase really hasn't changed that much in November. And if back in November you thought that the fiscal settings were broadly appropriate, then news since then aren't really enough to make you change your mind. And I'm now going to hand over to Ben, who will tell you some more about the specific issues around public sector spending and public pay.
Thank you, Isabel. I now want to take that fairly nuanced public finance picture and think through what it might mean for some of the options around spending and public services, and particularly around public sector pay. So I think it's useful, just as with the public finances, to distinguish here between the short term and the more medium to longer term. In the immediate term, the Chancellor is not short of challenges. He's not short of issues that demand his attention or issues that are demanding Treasury cash. I think public sector pay disputes are probably the most acute and maybe high profile of these, so I'm going to spend a bit of time on those. And then looking beyond just the next year or two to beyond the end of this spending review period and beyond the end of this Parliament, one of the decisions taken back in the autumn statement was to cut back planned spending on public services for the second half of this decade quite substantially. And those plans now look very tight, perhaps implausibly so, without some very difficult choices about what the state does and the scope of government that we can expect. So let's start on the short term. One of the most immediate challenges facing government departments and public services is that they're being squeezed by inflation. The cost of their inputs is going up, but their budgets are not being adjusted in light of that. So I'm going to show you here how planned spending over the Parliament has changed over time. So those yellow dots there, you can see that day-to-day spending on public services, on things like pay and running costs, was set to grow by 3.3% above inflation on average each year, and investment budgets, capital budgets, more like 7%. And over time, so that's now the red diamond showing you the spending review in autumn 2021, and those blue squares, the autumn statement of 2022. Inflation has gradually eroded some of that over time. And you can see something similar if we look at particular budgets. So notably, the NHS in England was pre-COVID, prior to the pandemic, planned to have average growth in its budget of about 3.4% over the 5 years. We've had a pandemic in the interim, but it's now looking at an average of 2.9%. And the same is true of most other budgets too. And one place where that is showing up and causing particular challenges is around pay. So the ongoing strikes across large swathes of the public sector relate to the pay awards for 2022-23. So those for the financial year in progress, the one that ends in April this year. Now, the precise offers varied by sector and by seniority of staff, but they averaged about 5% as a reasonable rule of thumb, pretty close to what the Bank of England estimate median private sector settlements were in 2022. But we don't really see that in the average earnings data. So if you look at average earnings growth in the two sectors, over the first 9 months of this financial year, in the public sector, it's averaged less than 3% versus more than 6% in the private sector. And that's a big gap. And using other data sources as well, there's some very clear signs that pay in the public sector has fallen relative to the private sector and underperformed perhaps what the outside option for many of those workers has been. So to show you that graphically, I'm going to compare average hourly pay in the two sectors here. So the green line is just comparing a simple raw average of what people in the public and private sector get paid. So a positive number indicates that average hourly pay is higher in the public sector. But you can see on the right-hand side there, it's been falling steadily over time and is now at a very low level relative to historic standards. And once we adjust for the fact that public sector workers are on average older, more experienced, they tend to be more highly educated, live in certain bits of the country. Once we adjust for those things, the line shifts down. And the key point here is that we've seen the largest year-on-year fall in relative pay, so pay relative to the private sector, that we've seen since these comparable records began. And it's now a record low relative to pay in the private sector. Now, this is just pay and it ignores other parts of the remuneration package, like pensions, but this is painting a very clear picture. And this is sort of partly explains why we're seeing strikes right across different parts of government. And that was about, those strikes are still ongoing, but they're about pay decisions this year. We're soon going to have to make pay decisions about next year, and that's going to bring a whole new set of difficult choices. So over the next financial year, the Bank of England expects CPI inflation of give or take 5.5%. They expect median pay settlements in the private sector of about 5.7%. Now that's the measure of pay that the Treasury says is the most appropriate comparator. But departments have said in their submissions to peer review bodies that they can afford max 3.5% within their existing budgets. And that's with some reprioritization. So the affordability constraint that consider is likely to bite. And as a result, we might see one-off pay awards or another round of below inflation pay awards if departments have to stick to those budgets. Now, the alternative is for the Treasury to provide some additional funding to allow for a higher pay award. If we wanted to give a CPI matching award across the entire public sector, that would add around £5 billion to the pay bill relative to 3.5% currently, according to departments, affordable. If you also wanted to go beyond that and undo the cut in relative pay, so relative to the private sector, that would be about an extra £9 billion you'd have to find. It's worth noting that in the short term, the Treasury's got what's called a reserve. It's like an unallocated line in its spending plans for unforeseen circumstances of around 13 or 14 billion. Now, a big chunk of that will presumably go towards funding support for Ukraine and other exceptional items like that. But it's possible that that could be the key to finding a few billion to unlock pay disputes in the immediate term. Now, affordability isn't the only concern. The Treasury have also argued that a higher pay award would add to inflation, and we need to be concerned about that. Although this, I think, while the argument, we can go through it in the Q&A if people are interested, but I think it's largely a distraction here. And the real constraint is this unwillingness to provide additional funding, because that would probably have to come with additional taxes. Now, looking beyond the short term, one of the key decisions, as I said earlier in the autumn statement, was to cut back post-2025 spending plans. So you can see that here. You can see these black diamonds show that in the short term, there was some extra money going in, particularly for the NHS and for schools. But then in the medium term, plans were cut back quite sharply. So more than £20 billion cut from these plans, which are only provisional, for 2027-28. And the same was true of planned capital spending or spending on investment. Those plans were cut back. Also, if we look just here at the day-to-day side of what public service funding is going to look like and some historical context, you can see here how how real growth has changed over time. You can see the steady increases of the 2000s. You can see the cuts of the early 2010s. So 1% per year, which is what the government's penciled in for after 2025. You can see here it would be no return to the cuts of the mid-90s or the early 2010s. It would be below the long-term 40-year average of close to 2% and below the close to 3% average we've seen over this parliament, but it would still be positive. But if you stuck to those plans overall, and once you start plugging in some reasonable assumptions about what might happen to, say, the NHS budget or the defence budget, you very quickly get on the right-hand side here to a world where you'd have to start making cuts to some areas. So that those unprotected other areas might include things like local governments or further education or courts or prisons. Areas like that could be facing more cuts if these plans were stuck to. Now, will they be stuck to? You might say, well, we've had some big funding injections over this parliament. They're still set to grow overall. We're not seeing a return to absolute cuts. What's the issue? I think there's three reasons why these plans are perhaps implausibly tight. The first is that we've already seen some big cuts imposed on most public services over the 2010s. Doing another round of cuts could have big effects on lots of services that have their own deep-rooted problems. In many cases, those problems have been worsened by the pandemic. There are backlogs, not just in the NHS, the one we hear about most, but across the court system, for example. There are lasting productivity effects. The pandemic has changed the nature of demand for some services. And the big overarching longer-term question here is, are we now going to be in a world where the government feels the need it has to sharply increase both health and defence spending at the same time? So I'm going to show you here how health and defence spending as a fraction of total spending have changed since the mid-1950s. You can see we've seen a steady reduction in defence alongside a steady increase in how much we spend on health. And that what we call the peace dividend, effectively, from lower defence spending has allowed us to steadily increase health spending without having to increase the overall size of the state or our tax take by too much. If both those lines start going upwards together, that's going to create some very severe fiscal challenges. So to sum up, there's no getting away from hard choices and hard trade-offs. Perhaps not an unsurprising message to get in IFS presentation. I don't think, for the reasons Isabel set out, we can expect OBR forecast improvements to ride to the rescue and make these tough choices go away. Those choices around public sector pay are particularly delicate and balanced. And after 2025, those plans look extremely tight, and maybe common sense and a bit of historical experience suggests they won't be stuck to. In all likelihood, we'll end up spending more. But those plans are still potentially significant, partly because they underpin the public finance forecasts that Isabel was showing you, but also because they might act as the baseline from which political parties at the next general election make spending promises to the electorate and those plans could cast a long shadow into the next Parliament and constrain whoever happens to be in government after 2025. That's all from me. Thanks very much.
Thanks very much, Ben. So I'm now going to be talking about the cost of living crisis, in particular focusing on inflation, energy prices, and also mortgage rates. So as Isabel already showed us, the last 2 years has been marked by a period of very rapidly rising inflation. So CPI inflation started rising in the spring of 21, reached 11% in October last year. It has started falling a little bit since then, and the Bank of England forecasts that the CPI inflation has now peaked and will fall throughout this year. And they expect that we're going to reach the 2% target in early 2024. Now, the main driver behind this inflation surge in the past 2 years has been the really sharp increase in gas and electricity prices. So in January, when the overall rate of inflation was about 10%, the annual rate of inflation for gas was 129%, and for electricity, it was 67%. And this kind of high energy inflation, on average, disproportionately affects low-income households. And that's because the lowest income tenth, for example, of households spend 3 times more of their total budget on gas and electricity compared with the highest income tenth. So this means that inflation is not felt equally across the income distribution, and that's what I'm showing here. So here we show the inflation rates experienced by each income tenth from lowest to highest, and these are calculated based on what these households have actually spent their money on. And what you can see here is that the rate of inflation that's experienced by the poor households is much higher than the headline rate of inflation. And the inflation experienced by the high-income households is slightly lower than the headline figure. And when we're looking at this split, we can see that these patterns are driven by energy and food inflation in particular. And this also means that we expect this pattern where the poorest households are hit the hardest by inflation to dissipate only once energy prices actually start to stabilize. So I'll now move on to talk about the outlook for energy prices that the households face. So the dramatic changes in energy prices have led to a huge amount of government support to mitigate the impacts on households over this winter. So here I'm showing the Ofgem tariff cap over the last 2 years without any government intervention. So the cap is expressed as the annual bill for a typical household. And you can see here that it rose from around £1,000 a year in the first quarter of 2021 to over £4,000 at the moment. Ofgem announced yesterday the cap from April will be £3,280. So it is lower than it is now, but of course still much higher than just a year or two ago. So to protect consumers from these kinds of really high prices over the winter, the government introduced last year the Energy Price Guarantee, or EPG. And that limits the unit prices as well as standing charges of gas and electricity at levels below the tariff caps set by Ofgem. So for the period from this winter, or for the period for this winter, the EPG was set at a level that implies an annual energy bill of £2,500 for a typical consumer. And then in the autumn statement, it was announced that that would rise by 20% to £3,000 in April this year. So the price that consumers face is the lower of those two, shown here as this blue line. And this blue line also takes into account the £400 reduction in bills over this winter. Now, at the time of the autumn statement, the wholesale energy future prices implied that the Ofgem tariff caps would have been above the EPG level of £3,000 throughout the financial year 23-24. However, we've seen in recent months the prices of gas and electricity falling much faster than what we expected to be the case in the autumn. So these green shaded bars here show the Ofgem tariff cap prediction from Cornwall Insight from yesterday for the rest of the year. So this shows that by July, the Ofgem tariff cap is now expected to fall below the EPG level, not just the £3,000 level, but also the current £2,500 level to about £2,100. And that means that although from April, consumers' bills will be determined by this new higher EPG, this is only going to last for about 3 months from April to June. So in other words, the price of energy to consumers is set to rise for a final time in April this year, peaking at 135% above the winter 21-22 level. And then we expect prices to fall back to close to the levels that we're seeing right now from July. Of course, that's still much higher than what we saw in 21-22. Just a caveat here, the energy prices, of course, are volatile, so this picture could still change before the summer or indeed before next winter. But another point that I want to make here is that while this picture refers to prices of energy that consumers face, this does not take into account the huge seasonal swings in how much energy households are actually using throughout the year. So if we take these prices and then we rescale each quarter by the average consumption of gas and electricity at that time of the year, this then gives us an estimate of energy spending based on typical usage in that quarter. So of course, someone with direct debit payments would see a smoother profile because their payments are smoothed out over the year. But this is a payment pattern that we might expect people on prepayment meters to see. But what this shows is that we expect there might be a short-term month-on-month increase in energy spending between March and April 2023 for some households because the energy price guarantee is going up and also the monthly installments of the £400 energy discount are going to end. But at a quarterly level, because households use so much more energy in the first quarter of the year than they do in the spring and the summer, these short-term increases in prices are going to be softened by a fall in the energy usage. So actually, broadly speaking, because of this falling usage, we expect that the peak pressure on energy bills is likely to be around now. And actually, the next tough period is likely to be next winter, because that's when energy use is going to rise again, and then the off-gen price cap is expected to be at about the same level as bills have been this winter with all the government support. So putting this all together in the next financial year, we expect energy bills net of any government support to be about 20% higher than they have been this financial year and over 80% higher than they were in 21-22. And finally, I'm going to talk a little bit about mortgage rates. So another key cost increase for some households, which is not incorporated in the CPI headline inflation figures, is rising mortgage rates. So the Bank of England rate was just 0.25% at the beginning of 22. It's now 4%, expected to rise another half a percentage point before peaking later this year. Now, of course, these increases in mortgage rates will mostly affect better off households as they are more likely to have a mortgage. So here I'm showing the proportion of households with a mortgage across the household income quintiles. And this shows that around 1/2 of the highest income fifth have a mortgage, or highest income fifth of households have a mortgage, compared to less than 20% among the poorest households. But among these households with mortgages who are going to be affected by rising mortgage rates, we expect that an increase in mortgage rates from 2% to 5.8%, which would be in line with bank rate increases since 21-22. That would, on average, reduce incomes after mortgage payments by 7.5% across these households, or 10% for households who have a mortgage and are aged under 45, because they tend to have larger mortgages. Now, of course, the impact of this is going to be felt gradually because so many people have fixed rate mortgages. But we do know that around 1.4 million households will come to an end of a fixed rate deal during this year. So all in all, for those households that are going to be affected by rising mortgage rates, we think that these rising rates will ease into their disposable incomes by an amount that's similar to the rates of inflation that we've seen over the past year in all non-housing items. So that's where we are with the cost of living crisis. And I'll now pass on to Sam, who's going to be talking about what the impact of all of this is on real earnings and especially working age benefits.
Yeah, thanks, Sadie. Yeah, so we've heard a little bit about kind of inflation and the direct effects that could have on households and their spending. But obviously it also has kind of implications for households' income. And I'm going to take a look at sort of the two key sources of income for households here, namely real earnings and working age benefits. So to begin with, we can look at what's happened to real earnings over the last few years. And if we firstly start off with what was happening before the pandemic, we can see there really was very little real earnings growth, kind of on average, just a couple of percent up to the pandemic over a few year period. So kind of not a lot of growth. However, surprisingly, after the pandemic, this trend actually reversed quite significantly. And although there was some disruption at the start, we can see that by March 2022, just prior to the invasion of Ukraine, average real earnings were actually 7% higher than they had been in December 2019. So this was a really big increase. However, kind of inflation had really took off after that. And what we've seen is that those gains have been eroded by inflation to the point where on average, real earnings are just 1% to 2% higher than they were 3 years ago in December 2022, that is. And this is true across the whole of the income distribution, where we saw that there were kind of quite significant gains made at all income levels. But since then, high inflation has really taken those away. One point which maybe kind of does differ here is those minimum wage workers, because the government has increased the national living wage quite significantly over the past few years. And so at least for their wages, while that might not translate to earnings kind of directly, those have been going up kind of above inflation. So that's the kind of implications for earnings, but you also think that, you might think that inflation would have less of effect on benefits, given that these are linked to inflation. But because of the way the government uprates, this isn't actually the case. So every April, the government uprates benefits by CPI inflation, but it uprates these benefits by the rate of inflation in September the year before. So obviously at a time when inflation is pretty stable, this might not make much of a difference because the rates are probably quite similar. But as you can imagine, when inflation is rising quite rapidly, this can actually lead to big differences. And obviously we're not uprating by the kind of rate at which prices are increasing. And so the real value of benefits can change quite significantly. If we start by looking at what was happening sort of in 2019 before the pandemic, inflation was pretty low. So you can see throughout the year, kind of the real value of benefits was not changing very much. And then following the pandemic, the government introduced the £20 per week uplift, which had increased the real value of benefits quite significantly. But as you can see, when the uplift expires, inflation has started to increase by this point. And so the real value of those benefits, despite the fact that there's been uprating going on kind of throughout this period, is actually kind of £50 a month below where it was prior to the pandemic. Now, when it came to April 2022, you might think that kind of the government's going to uprate benefits once again, and this is going to sort of address some of this gap. But in actual fact, this got much worse because the inflation rate in April was 9%, whereas the government uprated benefits by 3.1%, which was the rate in September. And so this didn't even come close to matching the sort of price increases that households were facing. And so you can see that the real value of benefits is actually falling a long way more than £100 a month below where it was before the pandemic. Now, this April, we're going to see benefits be uprated by 10.1%, matching the very high inflation that we had last September. And this is going to go kind of some of the way to addressing this. But as you can see, there's still a big shortfall for kind of households receiving benefits. And this is going to be the case actually throughout all of 2024 and won't be resolved until April 2025. So we're looking at a period of many years where, because of this kind of out-of-date mechanism for uprating benefits, households are being left with a big shortfall in the real value of their benefits at a time, when kind of lots of other expenditures are kind of very high as well. So to sort of cover this, what the government has done is it's offered these energy grants last year and cost of living payments next year. So these kind of big flat rate grants to try and help households who are struggling from the kind of this decline in their benefits. And as we can see here, on average, it does seem like these grants are going to bring the rate of benefits back in line with what they were pre-pandemic. Although I think what's very important to stress is what we're looking at here is only on average. And as we can see in this chart here, the kind of amount that households receive, this is just for universal credit, but for benefits as a whole varies kind of very widely. So some receiving more than £1,500 a month, whereas some receive £0 to £100. And what the government's doing is it's offering the kind of same amount, so £900 over the year to every household on means tested benefits, no matter how much you get. And so if you're thinking about uprating and increasing the value of your benefits by a certain percentage, this is obviously going to have very different effects on some households compared to others. For that reason, what we do is we look at kind of which households are compensated by these grants and which aren't. So what I'm comparing here is I'm looking at the benefit rates and entitlements that households are actually going to get this April, and add to that the cost of living payments. And I see if that's more or less than the amount they'd get if benefits were just uprated next April to be in line with their pre-pandemic values. So firstly, if we look just among all households, we can see that just over 10% are not going to be compensated for this kind of lack of timely benefit uprating. So the grants aren't covering this big gap in their benefits that has emerged over time. And that's more than 600,000 households, so quite significant. Although I think if you're kind of on the government's part, you might say that this isn't too bad coverage, and kind of the majority of households are going to be compensated. However, as we can look down, there are very big differences depending on the type of households and whether they will be compensated. So for those households with 0 children, you can see actually less than 5% won't be compensated. So they seem to be doing kind of very well out of this arrangement. And one example here is those single individuals with no children, who for them, they don't receive kind of very much in terms of benefits, and kind of uprating to the pre-pandemic level would only be worth about £200 across the 2023 financial year. However, they're going to receive £900, and so they're actually gaining kind of net £700. And this is obviously a big kind of giveaway from the government to them. And part of the reason that this policy is going to cost kind of living payments is going to cost £2 billion more than just uprating in a way that matches inflation and matches the pre-pandemic level. For those households with more children, so 1 or 2, they'll be receiving more benefits, so things like child benefit that kind of won't be being uprated by as much as they should, and so less are compensated, although still most of them. But what's really striking is when we look at those households with 3 or more children, almost 30%, which is over 300,000 households, are not going to be compensated by these cost of living payments. So really, many of these households are going to be kind of left worse off than they would have been if benefits kind of just had kept to their original value. And kind of there are other factors that can be important. So those entitled to disability benefits are less likely to be compensated, and those households in work are also less likely to be compensated by these payments. Another factor in kind of these grants and the way they're being rolled out is that it can distort the incentives to work for individuals, and that's due to the way that they're being paid. So for the means tested grant, so £900, it's going to be paid out in 3 payments of around £300. And the way this works is that if a household is eligible for universal credit in an assessment month, then they will, in the kind of in the chosen month, they will receive, as well as that universal credit, this kind of £300 payment. And this creates this jump that we see here in their budget constraint, where if their earnings become slightly too much that they're not going to receive universal credit, they also lose this £300 payment. So what you get is this area where a household could have higher earnings in that month, but actually receive less income. And obviously that's going to distort their incentives. And we think there are more than 800,000 adults who are in this situation where in these certain assessment months, they would actually be better off reducing their kind of the hours they're working, reducing their earnings, so that they qualify for universal credit, and also this big £300 payment. And so kind of there's these other effects going on with these grants that mean it's not kind of a perfect solution as well. To summarize, we've seen that across the earnings distribution, there's been a lack of real earnings growth since December 2019, which is a continuation of a trend that we saw before the pandemic. And this holds across kind of all earnings levels. We see, therefore, kind of average real earnings have grown by only 1 to 2% over the past 3 years. One exception to this is low wage workers, who have been helped out by large rises in the national living wage. In terms of benefits, this kind of out-of-date way of uprating means that despite benefits being linked to inflation, they're actually a long way behind their pre-pandemic levels at the moment. And this is going to persist until April 2025. As a kind of short-term solution, government's offered cost of living payments, so flat rate amounts that should on average more than compensate households in 2023, but at an additional cost of £2 billion. Despite this, we see that 600 households will still be worse off than if benefits are kind of uprated properly, meaning kind of in sort of real time. It's introducing these cliff edges to households' budget constraints that means that they have actually incentives to work less. And finally, the question remains for the government about what they're going to do next year, because by continually applying this sort of sticking plaster over the problem, this policy headache is just going to come back around to them next year. Okay, I think that's everything from me. So I'll hand back to Paul for the Q&A.
Thank you very much indeed to all four of you. Fantastic set of presentations. We're joined also by Carl Emerson and Rob Joyce in case there are any particularly difficult questions that we want to push in their direction. There's a number of questions in Slido at the moment. Thank you to everyone for those. And as ever, I will look towards the top of the list. There are two winners at the moment. With the there's now only one winner in terms of the number of votes, and it's a question about how Labour might change fiscal targeting if elected. Where I think we would have to speculate. We don't know how and whether they would. Most of what they have said thus far has been fairly consistent with a fairly traditional, as it were, view of fiscal targeting. In other words, a combination of looking to get debt down in the medium term and looking to, broadly speaking, balance the current budget, which of course the Chancellor wasn't able to do back in the November autumn statement. And it was very striking in a sense how the rhetoric didn't really quite match the reality. The rhetoric, as you'll remember, post the mini budget and in the run up to the autumn statement was of extreme fiscal rectitude. And whilst clearly most of the lack of rectitude that was in the mini budget was undone, the Chancellor couldn't actually find his way to getting on current forecasts to current budget balance over that period. I don't know, and this is one I think I will push to Carl because he is the world's expert on fiscal targets. I don't know, Carl, whether you have anything further to say on what Labour might do in terms of fiscal targeting.
I think one of the key questions I'd have is they do have plans to spend what looked like a rather large sum of money on green investments over potentially the first decade of Labour governments. I think there's a question about the extent to which that's extra over and above the kind of level of investment we might normally see a government be doing. So on top of, for example, the sort of investments you might see in things like education, health, etc. And then if that's the case, do they want to capture that within this idea that over the medium term we want debt falling? Because that might prove to be pretty challenging if they are genuinely going to spend that kind of sum on green investment. Those plans really are very big.
Okay, now we've got one which has very swiftly come up the ranks here from Andrew Tully. The question is, given we are around 18 months from an election, do you anticipate spending being tight in this budget so government have some ability for tax cuts and giveaways next year shortly before an election? Well, I'll pass over to Ben in a moment, but I think the situation over this Parliament has been that spending has not been particularly tight, and indeed, if you look back to the autumn statement, the Chancellor found a little bit more money over the period of this Parliament. The tightness in the numbers, as Ben showed, really starts to hit after the next election. So a bit of a difficult position being left for whoever is the next government. But Ben, do you expect anything to change in terms of spending plans over the next 18 months or so?
I don't think enormously. So what we've got at the moment is spending plans that run up to 2024-25. So basically, the next election, I think, has to happen before that. So we're not expecting another spending review or any sort of big set piece spending announcements probably before the next election. One area where I would be very confident in saying there will be a change is one strongly suspects the NHS budget will get topped up next year. In the NHS budget for next year looks relatively, there's no big increase there relative to this year, and it looks like potentially not compatible with some of the broader objectives around the health service, particularly if there is a bigger pay award for NHS staff, and history teaches us that the NHS budget always gets topped up virtually, so we shouldn't be surprised if we see that. But on the spending side, I don't think there'll be any, other than that, anything major. But of course, there's always room to be surprised.
There's quite a few more, I think, which are going to come in your direction, I'm afraid, Ben. There's quite a lot of interest in combination of health spending and public pay. Question here, which is a good one, which quite rightly often comes up, which is how pay in the public and private sector differ when pension provision is taken into account, given, of course, that pension provision in the public sector is very much more generous than that in the private sector. Does that change the shape or the scale of the chart that you showed, which showed public pay at its lowest level relative to private pay in since we've got those statistics?
There's a lot to unpack. It's a very good question. The first caveat is that a lot of the data I'm about to throw at you is from 2021. We don't have 2022 data yet to comment on this properly, but here's some stats. So about half of people who work in the public sector get an employer pension contribution worth more than 20% of their pay, 47%. In the private sector, that figure is 2%. The average employer pension contribution in the public sector in 2021 was about 18% of pay, more like 6% in the private sector. So yeah, pensions are considerably more generous in the public sector. And depending on your precise assumptions, you can reach different judgments about how much just more generous they are. If you do a similar exercise and you include pensions and try and estimate the difference between the two sectors, you get, well, we did that in 2021, and we found that average remuneration in the public sector is about 6% higher than in the private sector once you account for all these things. So there is still a sort of public sector pay premium. Now that's been falling over time, not quite as sharply as the chart I showed earlier, but it's still the case that the public sector has been doing a little bit worse in terms of growth than the private sector. One thing just to emphasize about the current situation, though, is that if you're in the middle of a cost of living crunch and you are maybe struggling to meet the bills, or you are, struggling to make ends meet, take-home pay may well be the most important and salient factor. It's very difficult to heat your home with a pension promise, very inflexible pension promise for 30 or 40 years hence. And so when it comes to short-term questions about recruitment and retention, and people are thinking about their outside options, it might be that take-home pay which is most important. And public sector employees also make larger employee pension contributions, so that further eats into their pay packets. So it's a nuanced picture, and I don't think it changes the overall trend or argument, but it does change the precise levels of that chart a little bit.
Fantastic. Thank you for that. Let's take a slightly different. I'm not going to keep taking things to Ben, which some of these questions are clearly aimed at. There are a series of interesting questions here about tax. What changes in capital gains tax are either likely or possible? I don't know what's. I mean, I will take that. I'll take that one, since our tax experts are not on the call, so you'll have to make do with me. What changes in capital gains tax are either likely or possible? I don't know what's likely, but I think it's fair to say that it remains the case that the capital gains tax regime is very generous to some people with very high levels of capital gains, and it's one of the things which allows private equity people, for example, to pay lower rates of tax than employees pay on their income. The main reason for that is that the capital gains tax rates are not aligned with income tax rates as they used to be prior to 1997. So a move back to the future, to the system that Nigel Lawson introduced, whereby capital gains tax rates are linked to income tax rates, but there is an allowance for purely inflationary gains. would be a great big improvement on what we've got at the moment. I certainly hope we see a movement in that direction, though I'm not holding out any great hope, I have to say, or any great expectation. There's a question here about lack of HMRC resources in terms of collecting taxes. I don't think we have any strong view on that, but we do know that there is a link between the resource that's put in and the amount of tax that gets paid. There's a question here which is a rather important one about the link between the cost of living crisis and rising rents. It's certainly been the case over a long period that housing costs, particularly for younger and poorer people, have been a big and problematic issue. Sam, or indeed Rob, on the call, what evidence do we have, if any, about the impact of rising rents on poorer households over this particular period of the cost of living crisis?
I can come in if you like. Well, we know, so rents, it's important to separate the private and social rented sectors, of course, where things can be quite different. Private rents are currently increasing a lot for new lets. If you look at just the newly rented properties, rental inflation is running at something at least as high as overall inflation. I think maybe slightly more, something like 12%. And it's been very, very high in London of late as well. Overall, of course, not all properties are new lets. Lots of people are continuing in existing rented properties. So overall, the rate of inflation for rents is something more like 6 or 7%. So still quite a bit higher than we have often been used to, but not so high, and less high than the average rise in the price of everything else. Of course, that's sort of important context here as well. For the social rented sector, social rents are supposed to go up by the current default, if you like, is actually CPI plus 1%. But because that would have been such a large number, they are rising, I believe, by 7% this April. It's been capped at 7%. So again, still high by most recent standards, but actually slightly less than the overall rate of inflation we've been used to. I think for those on lower incomes, and of course, increasingly, those renting are not just those on more modest means, given particularly the collapse in home ownership in recent times. But for those on lower incomes, at least as important, I think more important if we're taking a more kind of medium-term view over what's happened the last decade or so, more important often than changes in rents themselves is changes in the subsidies for renters. So bear in mind that anyone who's in the private rented sector and drawing on benefits to support their rent, the caps on how much they can claim in order to do that are not changing at all from year to year at the moment. They had fallen well behind levels of rents over the previous decade. During the pandemic, the government sort of undid that and put them back to where they would have been, if you like, for various cuts that came in from 2012. But now, year on year, we've resumed the policy of not increasing housing benefit caps at all, even in nominal terms every year. So for those reliant on benefits to help them pay their rent, things are going to be squeezing very, very hard. And then rent increases like 6 or 7%, like I just mentioned, are obviously a very, very big deal if you're already at the cap on benefits. So I think that's probably, for those on lower incomes, actually more important, if anything, than rents themselves.
Great, thank you very much indeed. And of course, for people on mortgages, the increase in interest rates is going to be a big issue over the next year or two, equivalent on average for younger mortgagers of a cut in their disposable income of around 10% as interest rates rise, which is quite a big impact for that particular group. Not on the whole, those who are on the lowest levels of incomes, but a lot of them on pretty modest incomes. Couple more for Ben, really about two questions together about health spending. From Tim, is there any resolution to the problem we've seen over the last 20 years, the government spending more and more of its budget on health and therefore cutting everything else? And then a question from Henry Anderson of the Health Services Journal. Given the slow progress in elective recovery so far, is the NHS going to need another top up in addition to those already announced if it's going to meet its target of doing 130% more activity or 30% more activity by 2025. Ben, your thoughts on the ever growing health budget?
I mean, there are a few fairly standard reasons why we would expect health spending to grow over time. So the aging of the population is the most obvious one, and the fact that people are living for much longer with multiple complex chronic conditions that can be a lot more expensive to treat. Those are fairly obvious, well-established facts why over the next couple of decades we might expect the cost of providing the same level and range of healthcare to our population is going to grow. A sort of longer sweep, there's an argument basically often known as Balmore's cost disease about how labor-intensive sectors like healthcare, but also things like education, it can be difficult to increase productivity in those sectors as fast as what's happening in the wider economy, but you have to increase pay in those sectors to keep pace. The classic example is a string quartet back in 1900, and a string quartet today might be playing the exact same piece of music, but the one today will be paid quite considerably more, or you at least hope they'll be paid considerably more. That's because their pay has had to grow in line with wider economic productivity. And that trend in the health service is something that in the UK and lots of other developed countries has meant growing health as a fraction of national income over time. I don't particularly see that trend changing unless the UK population wakes up one day and has a complete personality change in its view towards the NHS. In terms of the NHS and its elective recovery plan, it's true that when you look at aggregate treatment volumes, the NHS is lagging behind where it needs to be if it's going to be on track to deliver its 130% target for elective activity. I don't think that we should be so quick to immediately conclude that more cash is what's going to fix that problem. There's clearly deeper rooted problems in the way the health services, the system is managing with patient flow and how it's managing to how many beds are occupied. It's not obvious that turning on the spending taps in the short term would immediately unlock or solve those problems. If the government decides to offer a higher pay award, I think that would have to be accompanied by additional funding. Asking the NHS to find the cash for a 10% pay award, for example, from the existing budgets is just not feasible. So a lot depends on that pay question. But the answer can't always be immediately more money. I think we need to have a broader conversation about what's causing struggles within the NHS and why it's performing not as well as we might like, given the resources it has available.
Brilliant, thank you. There's a couple of questions here about why benefits haven't gone up in line with inflation and whether it's just because the computer says no. My understanding is that it's perfectly possible to increase universal credit very quickly, and indeed, we could be decided to do that now for April perfectly straightforwardly. I don't know, Sam or Rob, whether you want to add anything to that. It's the legacy benefits which are the problem, but the government seem perfectly happy to increase universal credit through the pandemic and do that differentially for other benefits.
Yeah, I think you sort of covered kind of most of the key points there. Is that obviously this kind of method of uprating has kind of been the same for a very long time, and previously kind of the reason given was the technology relating to legacy benefits sort of required time to then uprate those benefits and pay out the correct amount. But now with universal credit, kind of the payments go straight into the recipient's bank account, and obviously kind of that could be changed at a very short notice. And so given that the government with the uplift has shown a kind of shown that it kind of accepts that sometimes it might have to offer different policies to across the legacy benefits and those universal credit, then you don't really see why that it would be kind of denying this kind of more timely uprating to universal credit recipients now.
There is a sort of irony here, because you can go back to the Hansard records from some of the spikes in inflation from times past, like in the 80s or 70s perhaps, and find politicians lamenting the fact that, why on earth can't we increase benefits at short notice? What's going on here? Surely computers can sort this out. And the irony is that under universal credit, we finally arrived at a technology that does allow that, as you would imagine. as you imagine we would be able to, we finally can, but there is this possible awkwardness, as Sam says, that not every benefit recipient is on those benefits, but it would seem like a fairly extreme reaction to avoid helping millions of households just because you can't help even more than that. So I don't think there is a good reason for not getting ahead of this problem.
Absolutely, it does seem remarkable, and of course, those on the lowest incomes are the ones least able to cope with this kind of lack of flexibility. Deal with a couple of questions here quite quickly. I think. Do you think the government will do another spending review before the next election? I think it's pretty unlikely. We are less than 2 years away from an election. I think they're going to be quite happy to leave spending plans penciled in without being coloured in, as it were, for the period after the election, and there's limited time to make big choices around what happens over the next year or two. That said, I think we can expect some top-ups for politically popular bits of public spending, possibly in this budget, possibly in the autumn as we move towards the election, rather than a root and branch look at spending priorities. There's a question here about if the Chancellor wanted to reverse the corporation tax policy, how that would impact on the public finances. I think I'm right in saying that the Red Book suggests that the increase in corporation tax will raise something in the order of 20 billion a year in the medium run. So fully undoing that would clearly be quite expensive. It's worth saying, I think, that the amount that's raised in the long term might be rather less than that, as corporation tax probably does have an impact on investment. And indeed, this increase in corporation tax will take the UK corporation tax to quite high levels by international standards. So there are some risks associated with raising corporation tax so far and so swiftly. And it's worth saying that whilst that takes the headline rate still to 1 percentage point below where it was in 2010, the base has broadened over that period. So the corporation tax as a whole will be bigger over in the future than it was in 2010. There's clearly a lot of instability in government policy, where it spends a decade gradually reducing the rate of tax and then in one fell swoop basically undoes all of that. There is, the Chancellor must be thinking about possibilities here, which might be to reduce the level to which it's raised, maybe to something less than 25%, or perhaps more plausibly to be looking at whether there are ways of making investment incentives more generous, as they are in quite a lot of other countries. So wouldn't be surprised at all to see some significant discussion of corporation tax in the budget, and potentially, if there is space for tax cuts relative to current plans, it's the sort of area where I think the Chancellor might be looking, clearly trading off the fact that that might not buy him lots of political popularity, with the fact that that might be quite important from an economic point of view. Where else shall we go next? Is the government? What are your thoughts? I mean, there's a couple of questions on the need to increase spending on social care. Again, I'm afraid I'm coming to you, Ben. To what extent do we think that the problems in the health service at the moment are created by problems in social care?
I don't think it's the sole or even main explanation, but I think it's definitely part of it. So in 2021-22, the adult social care workforce in England actually shrank, and there was an increase in vacancies of around 50%. So there's clear signs of limited capacity in the sector, and you don't have to spend long talking to people who work in NHS hospitals to hear about cases where they're struggling to get people out into be cared for in their own home or to be cared for in a residential care home. So I think that struggles in the social care sector are definitely part of what's putting pressure on the NHS. I think that there's often a risk that we end up talking about social care as if its function is to improve or protect the health service. And actually, I think we should be thinking about social care on its own terms and what the important care that it provides to people who need it. In the years after 2010, when local government budgets were cut back, there were big reductions in the numbers of people receiving publicly funded care. So often when we talk about social care funding, we get bogged down in talking about funding reforms, the bill not proposal for a cap and things like that. Those are all really important issues, but they're a little bit separate from the question of, are the people who need care and support getting the care and support they require? And spending more on that might not lead to great benefits for the health service, but it still might be a thing that is worthwhile us doing on its own terms. That would probably require more funding for local government. Funding has to come from somewhere, etc. But we could spend a full hour again talking about all the issues around that. But I think it's a very worthy topic, and I think you can make a strong case for the need with an aging population to spend more on adult social care. Sure.
Okay, last couple of minutes here. I'll take very quickly one here about what do we think that ISAs, individual savings accounts, will survive. Unlike some commentators, I think we hope they will. It's not unreasonable for people to be able to put a certain amount of money into savings vehicles which avoid double taxation, though it's very striking that if you're a high earner, you can put more in an ISA than you can in a pension. So one of the things that we have been talking about in recent reports is the need to reform the taxation of pensions for all sorts of reasons. It is too generous in some respects, offers complete freedom from inheritance tax, complete freedom from any income tax for a quarter of what you save, freedom from national insurance contributions if employers are putting the money in, but it's too tight in other respects, partly as a response to that. And as we know, some of the limits around annual and lifetime allowances are behind some of the problems, for example, in high earners in the health service staying on. There's a question here. I don't know, Isabel, whether you can help with this. It says your expected revision to revenues in 23-24 rests on an upgrade to GDP growth in 2023, but since the autumn statement, the overall level of GDP was revised down, so the economy is smaller. But I don't think that necessarily that's certainly not reflected in the revenue statistics we've had over the last few months.
True. So actually estimating the level of GDP is an inexact science, well-kept secret of economists everywhere. But I think it's fair to say that if we care fairly narrowly, perhaps, about tax revenues, then the news has been unambiguously good. And for sure, there's uncertainty around both the factors I mentioned, so both the shallower recession and the kind of higher tax take conditional on the size of the cash economy. But I would be fairly confident that we should expect a substantial downward revision to borrowing based on those factors. Whether it's going to be exactly this, whether these trends are going to continue in exactly the same way from this year into next, is of course a more open question.
Great. Thank you. We are rapidly approaching, or pretty much at, 11:15. So I think I will draw a halt to proceedings at this point. Thank you so much to Isabel and to Ben, to Heidi and to Sam, and to everyone who has been watching. We will, of course, on the day of and the day after the actual budget, which is only just over 2 weeks away, be analysing as quickly as we can everything that the Chancellor says and everything that's in the Red Book. We will be holding tune in to that and see what we have to say about what actually happens once it's actually happened, rather than us speculating about what might happen. And once we've seen not just what the Chancellor is doing, but what the problems the OBR has thrown at it. So thank you again, everybody, for your time, and we will see you soon.